Hey, do you think you need a massive portfolio of high yield stocks to be a serious dividend investor? I fell into that dividend trap way back in 2018, and I'm going to show you why you might want to avoid it too and what I learned along the way. What's crack-a-lackin', y'all? I'm Russ, a welder, sharing my passion for passive income. And before we dive in, a quick heads up. I've got a free weekly newsletter at DapperDividends.com that's packed with my latest thoughts and portfolio updates. And by the way, SeekingAlpha.com has been a game changer in making me a better investor, and you can save a bunch of money on an annual subscription with my affiliate link below, or not, whatever. So picture this, it's 2018 and I'm all in on high yield, low growth dividend stocks like AT&T, Verizon, and Altria Group. I mean, you know the ones, stable, juicy dividend yields that aren't off the charts. My brilliant plan? Sit back and watch that sweet cash flow just roll in year after year. But then, plot twist, community members started questioning my strategy. Russ, they'd say, why the heck are you chasing low total return investments when you don't need to live off the dividend income yet? After hearing that a bunch of times, that got me thinking, what am I missing? So I started digging, and man, did I uncover some pretty eye-opening stuff. Those high-yield, low-growth companies like Verizon and Altria, they're just like old, reliable, dependable, but they're not winning any races. They're mature businesses, mostly done growing and just handing out cash to shareholders. It hit me like a welding spark when I saw this chart. So check this out. This is a total return chart over the last 10 years. So this is including all dividends received. Look at this. AT&T has a total return over 10 years of 28.12%. Verizon clock in a little bit better with 33.04%. So they are just pretty much flat. Altria, a little bit better with 118.65% total return. Now check out what happens with the low yielding Visa when we look at that. 437.78% total return over 10 years, just crushing AT&T and Verizon. And then we got Costco, has had a hell of a run as of late, 788% total return. And in almost every instance going back before it started this gargantuan run up, it has outperformed AT&T, Verizon, and Altria. And then for good measure, I threw in ticker VTI, which is the total investable US stock market, as kind of a baseline. And you can see right there, it has been also beating Verizon, AT&T, and Altria with a total return of about 222.52%. So had you just invested in that, you would have had more money than doing an AT&T and Verizon and Altria. And by the way, this chart is on SeekingAlpha.com, and you should be able to do this for free as well. This is linked in the description below, a spreadsheet I put together for you so you can kind of get a little bit of a flavor what it would have been like could you get in that time machine and go back 10 years and put an investment into some of these businesses. For example, we've got Apple here. The current yield is right now, as of this recording, about 0.44%, which a lot of you will say is just too low, right? 10 years ago, the starting yield was 1.91%. Had you bought a share of Apple and held onto it for 10 years, your yield on cost would be 4.10% right now. And the dividend growth on that is about 8.12% every year for the last 10 years. And a 10-year total drip return, meaning had you plowed all the dividend income right back into more shares of these stocks, in this case Apple, you would have a total return of 1,000 and pretty much 41% for an average annual total return of about 28%. Now it's kind of interesting when we look at the bottom here. A lot of the lowest average annual total returns were some of the ones that had the highest starting yields, like AT&T had a 5% starting yield. Intel, not so much. Verizon, 5%. Annaly Capital is a popular mortgage REIT that a lot of people chase, had a starting yield of 5%. But when they're giving so much cash out to shareholders, they're not reinvesting back into the business. I understand Annaly's an MREIT, and they have to do 90% to keep the REIT tag, but the proof is in the pudding that you would have only had a 55% total return had you over the last 10 years reinvested all of those dividends, but you would have a yield on cost of 11.13%. Now, I built this using data from seekingalpha.com and from our free friends over here at dividendchannel.com, where you can click on the calculator tab and you can go back to 1995, but I want to see SCHD popular ETF versus the S&P 500 VOO. So what it's going to do, you can hit the button here, chart $10,000 invested over the time frame you select between two holdings if you like, and then you'll get a pop-up window that's going to have two different things. The top one will be the growth of $10,000 with dividends reinvested, buying more shares, and then without dividends reinvested. So SCHD would have a total return of 191.74%, but the S&P 500 did beat that out a little bit, and you got your average annual total returns here. A very cool tool to do a little bit of back testing. But I like this, where it will show your starting shares 10 years ago would have been 257, but after dripping and getting more shares, and then that's money compounds on top of itself. Those more shares get more shares, and so on and so forth. You would have ended up with 354.40 shares. And then the chart pretty much kept in line, but VOO, as of the tech boom, the AI craze, then maybe it's a bubble, has really pushed that up. Why? Also because the Mag 7 are, I think, 35% of the S&P 500. That doesn't seem healthy to me, that a diversified fund like the S&P 500 stocks, every $100 you put into that, $35 is going to just those top magnificent 7 businesses. So I think a little bit of a rebalancing here, or a rotation, is healthy. So with this new knowledge, I shifted gears and started hunting for stocks with solid businesses and dividend growth potential. It wasn't just about the yield anymore. It was all about the total return with a side of passive income. Now, what sucked was my PADI, my projected annual dividend income, decreased, but the potential total return shot way up through the roof. So my big lesson was to stop chasing yields and start chasing returns from high quality companies. If you're a young investor, or really any investor that's focused on long-term growth, I think you have to consider total return. And if you aren't ready to use that dividend income to live on and pay some bills, it might make more sense to invest in low yield, high growth companies that also happen to be paying a quickly growing dividend. And because you'll likely have a higher total return, you can always cash out those Visas and Costcos for some higher yielding AT&Ts and Verizons. I want to hear your take on dividend investing, so share with all of us your tips, experiences, and even disagreements in the comments below. And if you found this helpful, tap that thumb. And if you're new to dividend investing, in this floating little box next to my head, I had a chat with the brains behind the Dividend Millionaire book, which I also have linked below. So if you want to hear a really cool interview with a really cool guy, click the floating little box next to my head, and we will see you there.